Hello again, it's Martin North from Digital Finance Analytics. Welcome to the latest posts covering finance and problem news with a distinctively Australian flavour. Well, I'm on the way up to Sydney today, going to meet a whole bunch of fund managers and other people to talk about the mortgage industry. So hopefully I'll be able to catch a bit of the conversation and give you an update as I go. Of course, it's a bit of a trek to come up to Sydney from where we're located down on the south coast, but there again, sometimes it's worth it, and hopefully the trains will be running well. So we're going to cover the latest in terms of what's happening with regard to mortgage demand, home prices, some of the default questions that we have, and also mortgage stress, and some of the other information with regard to the profitability of the banks. So it should be quite an interesting session, I think. I'll give you a bit more of an update later, and we'll see how we go. we good to go then?
Yeah.
All right. Okay. So just a few sort of background slides then. But I regard this as a discussion, so feel free to chip in and throw questions. I'll try and answer them. So DFA, just what we do on slide 2. We do some very detailed primary customer research. So we survey 52,000 households each year. Rolling survey, 4,500 new each month, and we look at their financial profiles, their plans, their aspirations, their mortgages, their overall financial footprint. So we've got a fairly rich understanding of consumers and how they're working. We also incorporate other information from ABS and anywhere else I can get information. So I'm a bit of a data sucker-inner, but I put it into my core market model. The core market model is essentially my core analytic tool. So today I'll show you some of the information out of the core market model. That drives our research, that drives our various blogs, our YouTube channel work, and custom assignments with clients as well. So that's what we do. And the thing to think about this data is it's like a Rubik's Cube. So you can, on sort of slide 3, you can sort of twist it and turn it and look at different customer groups, different geographies, different segments, to try and understand what's really going on. That's really important because a lot of the reporting that's done from the Reserve Bank and from APRA is extremely high level and is very ungranular. And if I give you just one example of that, when they mark their property portfolios to value, as they do occasionally, they do it at a very high level regional average. So in a way, granularity is not really the friend of a lot of the reporting that's out there in the public domain. So I try to get granular. And I think you'll see that's quite important as we go forward. One of the things that I do is to look at the household cash flows. So particularly money coming in each month, money going out each month. And if they have a cash flow deficiency and a mortgage, it means that they're basically under pressure to make those mortgage repayments. So I've coined the phrase mortgage stress, and I plot mortgage stress each month. I've been doing it since the early 2000s. And this chart on slide 4 shows you that the yellow line, mortgage stress, is as high as it's ever been. And just reflect on that. Interest rates ultra low. We've had some correction in home prices, etc., but mortgage stress is really high. But the other dimension, I also look at the RBA data on household debt, and of course that went up to 191.1. So we are in the situation where, despite ultra low interest rates and despite all the enthusiasm to try and get people to come back into the marketplace, we have mortgage stress that's never been higher, and we have household debt that's never been higher. And there are some people out there who say that's not a problem because with really low interest rates, serviceability is not an issue, except that my mortgage stress says, well, it probably is, by the way. And the second point is that you've still got to repay the debt at some point. So this is a big deal. And I keep saying, and I continue to say, we've got too much debt in the system, and we've had an economy that's driven by household debt for at least a decade plus. We haven't had a plan B, and now, of course, the RBA and the government and everybody else is trying to enthuse people to back into the market. Seems a dumb strategy to me, but that's just me. But the point about mortgage stress on the next slide is, and this is just a Sydney example, I've got a few other ones we can go through if you want to look at other states. Mortgage stress is not uniform across individual postcodes, right? Different types of households in different locations have different degrees of mortgage stress. Now, there are a few different ways you can map this. You can map it in the absolute number of households. What I've done here is the percentage of households in stress by postcode, right? And what you can immediately see is it's predominantly, but not exclusively, a Western Sydney problem. Well, not a surprise there. A lot of these postcodes are in, and it's the darker blue ones that you want to look at, are in areas where there's been very significant building expansion in the last 5 years plus, where we've still got more building going on, where people bought in at the top of the market over 2 or 3 years ago, and where the incomes are severely under pressure. There's no income growth at all in some of these areas. In fact, in some cases, income is receding. For example, those in the construction sector are really struggling. There's about 1 million people working in construction. About 20% of them we think are under severe pressure at the moment, and that's a big deal. Also, cost of living are rising, and interestingly, out here in the West, a lot of the infrastructure hasn't really been built yet, so people are completely fixated on getting in the car and driving, which means that there's a lot of costs involved. Right, when fuel goes up, that's a big hit. But we also got things like childcare. We've also got things like healthcare costs. In fact, pretty much all of the major category items are actually in difficulty at the moment, and that's a big deal. So the problem I've got is servicing mortgages at the moment is a real problem in many of these postcodes. Now, the other thing to say is if you look over in the Sydney basin more closely, you can see them spot codes there as well, right? So in some of the inner city areas, a lot of those are units. So people bought into property units 2 or 3 years ago. Again, top of the market, prices have dropped. In some cases, prices are down 30% for units. And the recent discussion about the issues to do with poor quality construction, defects, flammable cladding, ain't helped, I can tell you that. And you know, the Mascot Tower and the Opal Tower story. There was another one that came out over the weekend. Last week, South Australia identified 30 high-rise units that actually have flammable cladding that needs to be addressed straight away within 12 months. They're not telling anybody who those are because they don't want to scare the horses. But and the point I keep making is the unit sector is really stressing out, right? And another example, North Ryde. If you go up there, and there's a lot of high-rise development up there, again, prices are still down 30% plus. If I go out to houses in the West, 30% down as well. The average values are down there for houses, and the price of land is now half what it was. And remember that this is the proportion, right? If you look at the absolute number, the distribution does change a little bit. But this is quite a powerful tool, right? Because it shows you where the potential issues are. Now, the reason this is important is I mapped this, as I always do, over in the West about 2 years ago. And I identified a postcode over there called Mandurah, over in the West. And I predicted that that was going to be a difficulty that will just run and run, right? Now we've got 35% to 40% home price drops. We've got social issues. We've got people effectively, not going out at night because they're worried about the drug dealers. The social consequences of the stress and the financial pressures that people are under follow through. And the concern I have is that what I was seeing in the West 2 or 3 years ago, I'm starting to see down here in the western suburbs of Sydney, and it's similar in Melbourne, and it's similar in some other places too, for example, even in some areas of Brisbane, particularly out west towards Toowoomba. So the problem is that granularity shows you a whole lot of new stuff that you don't see otherwise, right? Mortgage stress is a very early indicator, right? What people do is they actually raid deposits first, they put more on credit cards, right? So you can keep this ship afloat for some time, but at some point they cross a Rubicon, and that's what happened over in the West about a year ago. Over there, the default rates are 3 times what they are over in the East Coast, right? And they're going up still. The banks are now starting to foreclose in the West because they're not seeing a correction. In other words, coming back to where they were previously, so they're having to deal with it, right? I think that this is going to be an argument based on, well, interest rates are going to get even lower, so therefore that's fine, and maybe incomes will start to rise, and so we can muddle our way through it. I'm just not so convinced as the banks that that's the case. The thing is, volumes are really low, so we know transaction volumes are still low. We know that there's an unequal distribution of different types of property that's on the market and selling. The very expensive suburbs, like Vaucluse, I mean, they're not really caught by, mortgages and what have you. People can afford to buy if they want to buy over there at any time. So those suburbs are definitely rising. But we're not seeing it in units, and we're not seeing it in the West. So it depends on how you calculate the aggregate indices, right? And the CoreLogic method, which is the hedonic index, no one actually is clear, I don't think, about how it works.
Well, they don't explain to us why it just skyrocketed one day randomly.
Exactly. And they lost 4 months ago the home track data. Right?
Okay.
They used to have the home track data, which is the REA data set. The home track data was what all the real estate agents put in every time they did a sale. So my question now is to CoreLogic is, so where are you getting your immediate transaction data? And remember the other thing about auction clearance rates,
The reporting bias.
Yeah, reporting bias, because the real estate agents will be, I've sold another one, and particularly if they think that property value has been over the average. But about 1/3 of auction prices aren't reported. So it's a very small data set. So I'm just a bit sceptical. I'm not saying there isn't any price rises, but it's not that I think we see. So I run my own price algorithms. I don't make it public because it's still sort of temporary, right? But my analysis of price movements is much closer to what REA said. And I didn't prompt her, right? I thought she was going to sort of talk about...
Talk it up,
yeah, but she didn't. And by the way, she did the same the following week on the Switzer programme, right? So it wasn't just me and DFA. She actually said it in other contexts as well. So I think that's... So what I would say is, do not necessarily take at face value all of that high-level price movements that everyone's talking about. And I can tell you down in Wollongong, where I come from, prices are still falling there. They're falling still in Newcastle. So some of the regional areas, we're not seeing any recovery at the moment. And if you segregate the West and units, huge issues, right? So any of these areas where you've had that big expansion, all along the Parramatta River, it's still falling. So there is a much more important, more granular story to tell, in my view, about what's going on relative to the high-level media. And I shouldn't say this, but just remind you that Domain, Channel 9, the papers, I mean, they're all sort of connected, if I can put it politely. A lot of people in difficulty can't refinance because they can't get the cheap mortgages that the banks are offering to new low-risk credit, right? So there's a real big discussion about what I call mortgage prisoners. So these are people locked into higher rates, they can't refinance the lower rates. The second is that, of course, the banks didn't necessarily pass on the full amount, and of course the ACCC is now called back in to look at the same issue that looked at, was it a year ago, 2 years ago, and the Productivity Commission looked at 2 years ago and last year. Why is it that the banks actually milk their legacy customers? You've got to be proactive to be able to actually get those cheaper loans, and not everybody can get them. My research says that the lower risk credit can easily refinance and save a lot, but pure mathematics of the volume of transactions in the system and the volume of households that are actually in difficulty, there's 1 million of them who are in difficulty, it's still not enough to correct mortgage stress. And I can't see anything that will correct mortgage stress unless, one, incomes really start to rise, strongly rise, or two, costs really come down. And given the fact that we're probably going to be importing inflation because of where the dollar's going, and the fact that because unemployment's rising, I don't think income's going to rise, I'm of the view that mortgage stress, if anything, is going to go higher rather than lower from this point. So just think about this. There's more than 3 million households with mortgages, right? What we're saying is 1/3 of them have issues. Right, 2/3 are fine. Of those that are fine, quite a few of those are actually paying debt down. So we've got this weird situation where the total credit number is falling, right, at a time when the banks are lending a little bit more, but the households with the stress, with the financial flow problems, aren't actually self-curing. Okay, on page 6, I've just pulled out the segments. I told you we used Rubik cubes to sort of look at it, right? So this shows you just the total number in stress and the total risking default. Now, risking default is a predictive estimate based on our models. We've been running it for a number of years. It's quite accurate. We predicted Mandra. It's now happening. So young growing families have the highest levels of stress. 54% registered a financial flow shortfall. So half of younger families are battling urban and disadvantaged fringe groups, which are those living on the outer suburban ring, registered 46 and 47%. But the really interesting point here is the fourth highest is the exclusive professional segment. So this is the top end of the market, right, at 24.7%. So there are some affluent households leveraged to the gills, and the interesting thing about them, if you look at the average loan and if you look at the amount that's lent to this particular group, it is bigger than all the others. So what this tells you is that there are issues not just in the typical battling segments, but even at the top end of the market, even in some of the more exclusive households. And it's got worse in the last 6 months compared to where it was. So something is happening in that group which I think is quite concerning. And even the suburban mainstream households, which is, you know, the largest single segment, but some of them are in difficulty, so it's quite widespread across different segments. And I would also just mention that some of the older households, the people moving into retirement, they've still got mortgages. A much higher proportion of households these days have mortgages into retirement, and what it means is that they are less able then to service those, and therefore they get into difficulty. So, you know, people hold bigger mortgages for longer. And the interest-only thing hasn't gone away, right?
No.
Because everybody keeps saying, well, isn't it solved? No, the answer is no. There's actually more interest-only loans rolling in the next couple of years than have to roll. And it might be worth at this point just taking a slight detour to talk about those underwriting standards, because, you know, the sort of the official view is, well, that loosening, there's been a big loosening, etc. There's been some loosening, but they're much more selective than they were.
Yeah.
And the hem is now tighter than it was, the household expenditure measure. And interestingly, of course, according to your research, there are now more LAR loans than there was previously.
Yeah, that was a good one.
Okay, the other thing is financial confidence. So this is the other key dimension in our analysis. So we ask households about how they're feeling about income, expenditure, costs, savings, loan, and their net worth. And this is actually quite dramatic, because what this is saying is, and the dotted yellow line is the average for the whole of the household group. 84.2 is the latest measure, and this is lower than it's ever been, which is actually, it's on page 8, is pretty amazing. And interestingly, even those without mortgages, so what I call free affluents, these are people with properties, with no mortgage, they're below the average as well, below the 100, right? Those with mortgages are declining. Those with investment properties, as I'll show in a second, are actually also struggling. But it's pretty much across the board. And this is sort of not surprising. It was what I expected, but a lot of people were expecting confidence to bounce back because of low rates, you know, the rate cuts. Why haven't the rate cuts translated to boosting consumer confidence? The answer is consumer confidence is low because people feel under pressure. They don't have the financial freedom they had previously, and a lot of them are in mortgage stress. So it all is consistent. So that's how it's sort of flown through. And you can see there by the age bands on the next slide 9 that in fact it's the young households, 30 to 40 and 20 to 30, who are actually the least confident. A lot of those have mortgages. A lot of those are also renting. But I'm also quite intrigued that the 50 to 60-year-olds, which tend to be more confident, are actually declining as well. And the reason for that is that those are actually reliant on income from deposits. And there are about 3 million households who are genuinely reliant on income from deposits, and income from deposits has been crucified because of the low rates that have been happening. And a lot of the surveys that we've asked people specifically about this is that, look, we're not going to shift to more risky alternatives. We can't afford to do that. We just don't want to go into the stock market. We don't want to go into bonds or anything else. So we're just going to spend less. And this confidence thing I think is really important, right? Because if it is the case that the government is looking for the household sector to do some more heavy lifting in terms of the future of the growth in the economy, I ain't seeing it. And in fact, you can look at it by states, which is on slide 10, because effectively that information is showing that pretty much now all the states are bunched together in terms of average confidence. And on slide 11, you can see there that it's actually property investors that are not particularly happy. So property active investors, these are people with multiple investment properties, they're the ones who are actually really up against it. And they're talking about rental streams being compressed, because if you look in Sydney, the average rent is dropping. They're talking about the underwriting standards still being very tight for investment mortgages, and of course there's no capital growth for many of them, particularly those holding units. So I think this is quite an important sort of context in terms of what's going on in the economy. And it's worth saying, if I just go to on slide 12, you know, the ANZ Roy Morgan research came out last week underscored the same thing. So it's not just me that's saying there's an issue with confidence, it's actually in some of the other surveys too. And in fact, as Westpac pointed out, you know, the business confidence and consumer confidence are both pretty wobbly at the moment. And
Business confidence is also, I think, very important because I survey the SME sector as well, and that includes a whole lot of traders. And I'm seeing a lot of traders who are actually really struggling at the moment. A lot of them are saying, well, we're working 6 or 7 days a week, we're now working 3 or 4 days a week. We don't have a forward pipeline. And the data on page 14 shows that retail sales are coming down, that's the consumer, and the dwelling commencements are down, that's the construction sector. So the question is, yes, thanks. So the question is, what is driving the economy? Well, the answer is balance of trade, although it came back from slide 15, a high in oil price, which was rather convenient but sliding, and government infrastructure investment. But there isn't really, that I can see, a growth strategy that we've got in Australia. Just throwing more money at households and getting them to borrow more property ain't going to work. At least that's my view. On slide 16, you can see that the net lending flows are higher, or they're plateauing. So these are new loans coming in. I was expecting to see a bit of a bounce following the rate cuts and following the APRA loosening and all those sorts of things. What's interesting is that last month didn't seem to move up as much as previous month. So maybe that was a bit of a sort of a May, June, July reaction. Be interesting to see what happens ahead. But of course, the overall credit growth on page 17 is as low as it's ever been, with total household credit 3.1. Investment lending still well down. So the credit engine, to my mind, is not firing particularly strongly at the moment. And that's going to be an interesting conundrum for the banks. It's going to be an interesting conundrum for the government. There isn't a huge amount of forward buying coming through from my survey. So 3 months ago, there were a lot more people thinking they would buy up into spring and would list their properties. That's gone away again. So I wonder whether, in fact, we've seen a bit of a sort of a little bit of a spike, but it's beginning to ease out. No, it's too soon to say, perhaps. But my forward indicators are negative rather than positive.
So strong.
There's two things. Firstly, the number of people who were expecting to list spiked in May, June, July, and then it's come down again. So, and we're seeing listings well down on what people expected. So people are not wanting to sell, not needing to sell. And then on the buy side, there are people who want to buy. First-time buyers are a little bit higher, although not dramatically so. A lot of the people who I call down traders, these are people with big properties, sitting on equity, are wanting to try and move down, but they're not finding people wanting to buy those properties. So there's some very interesting dynamics going on there. I'm not convinced that we're going to see a huge bounce in property prices or indeed credit growth over the next few months, but we'll see. It's too early to say. On slide 18, we touch on the core logic. So core logic says that property prices are up, particularly in the upper quartile, particularly in Sydney and Melbourne, still down in Perth. Canberra is slightly higher as well. By the way, Canberra is a unique market because of the fact that most people are in the public sector. Public sector wages are growing a lot stronger than in the private sector. Yeah, September quarter, yep. So it's just the last quarter by the different segments, by location. The other thing is that 90% of approvals in Canberra over the last year were for high-rise. 90%. That's the highest in any location. It's because there's been a massive speculative bubble in Canberra. A lot of those buildings are being built by a relatively small number of construction companies that already have issues with the ones they've already built. And there's a huge oversupply now of units. One of the reasons why we think home prices in Canberra for units will slide. Convert more of Australia into the public sector and we'll be fine again.
That's what they do.
And as we discussed, there's a post on the DFA blog and on the YouTube channel about this data analyst. This was the REA chief economist who basically said, look, we're not seeing what CoreLogic's seeing. REA. So basically REA has a strategy of effectively wanting to expand its footprint, and they've got all of these flows because basically if you want to list on the realestate.com.au, you have to put a lot of information in if you're a real estate agent on day one, and you commit to also to put information when it sells. That's the home track data set. Right? Now that was previously flowing into the CoreLogic system, and it was basically a very rich source of early data, because otherwise you've got a 3-month delay because of the value of general data, right? And the 3-month delayed data doesn't necessarily help you with the hedonic index on a daily basis. That's an open question. Who's right? We'll see. I guess in 3 months, Glory. So one of the things we do with our modelling is then run our own scenarios, and this is a way of trying to understand what we think could be happening. So I think the best case, if the Reserve Bank is playing its book to cut rates again, the employment rate drops a little bit, I think mortgage stress will probably stay around the same level, and over the next couple of years, so I'm looking from a few months back forward for a couple of years on this, I think there is a path to home price growth. But so it's basically over a 3-year horizon, a year back, and then looking forward 2 years. Right? So home price growth, there is a path, but it's only a 10% probability on the data that I'm seeing. And then basically you can see that the other scenarios get increasingly more serious in terms of if in fact the unemployment rate continues to rise, and despite credit rules changing and easing and fiscal stimulus, there is still a path to some home price correction. I give the second one a 30% chance, but I also have to take account of the fact that the international scene, although it was buoyant at the end of last week because of Trump and trade and because of the Brexit situation, there are lots of international pressures, and so the fundamental point to make is that on an absolute basis, prices for property are still 40% over the long term where they should be. And that's where Steve Keen and I agree that there is a distortion in the marketplace. The question is, how undistorted will the market become? And that's going to be determined by the international context, I think, more than what's happening locally. So you've got to look at gross and net rental yields,
Sure.
right? So the gross rental yields, you're right, 2 and 3% typical, but the net rental yields, about half of investors are actually underwater, if you take account all of the costs of running the property and paying the mortgage and everything else, right? So they're actually losing money. That's one of the reasons why property investors are very negative, because the economics don't work unless you get strong capital growth. So that's one of the dynamics that we're definitely seeing very strongly at the moment. And the number of property investors who've said in our surveys, we think we've got enough property and we probably will be shedding property rather than actually buying more property, is swinging into a much larger proportion of the households. Particularly because of the interest-only thing coming to an end, and particularly because the future capital growth is very uncertain. A lot of the people bought units, and like I said earlier on, the unit prices are dramatically down, and my own view is that the flammable cladding and the poor quality construction is a big deal. There are thousands and thousands and thousands of properties that are going to get caught, and a lot of people don't want to mention the cracks, because if they mention the cracks, their property value drops, right? And so there's this. I had a few private correspondences between property investors and even people living in these places saying there are cracks, but we don't want to mention it because we're concerned if we do, then we're going to suddenly see our property values fall. So that's scary.
Exactly what we just heard this morning from an industry participant, that it's much worse than what the media is even talking about.
Yeah.
So,
well, I ran some back of an envelope numbers. It's only an estimate, but this could be $1 trillion problem if you take account of the value drops, the amount of cost to repairs for all the various buildings that are there, and just the structural changes in the approval process that need to be put in place going forward. This is not a trivial issue. And by the way, the government response so far has been to sort of look the other way and say, well, it's somebody else's problem, right?
Well, fair enough. It's not the government's fault. Someone built a shoddy building and someone else bought it.
Yeah, but the
government shouldn't come and bail everyone out.
No, I agree they shouldn't, but absolutely agree they shouldn't. Although people in New South Wales, Mascot Tower, saying...
Mascot says
Yeah,
come and the
yeah.
government should bail me out and taxpayers should fund it. No thanks.
But the private certification that came in, 10, 15 years ago was to save money, right? And to free up building. So there is a state accountability for those approval processes. And the problem we've got is now we know that nobody on these big construction projects are actually taking end-to-end ownership of the quality of the deliverable. And often there'll be a building corporation created for a particular project that disappears at the end of the project, so there's no recourse. These are big issues. And it's not just Sydney and Melbourne, it's Canberra, it's Darwin, Perth, Gold Coast. I think the Gold Coast is a real sleeper for this.
where you're seeing data improve is in the core. Where,
Yeah. So it's not foreign buyers.
yeah.
Foreign buyers haven't really come back hardly at all, and the Hong Kong factor that everyone's suddenly talking about, I think, is very, very limited at the moment. There is strong interest in blocks with a house on it in the inner suburban ring, particularly from developers who want to actually knock it down and put 2 or 3 on it, or indeed people who actually want to buy a high quality block with a high quality house on it and live close in. So that's where a lot of the action is. It's much stronger than in the unit sector. Some of that's from investors, some of that's from small builders who want to try and do that, and some of it for people who want to live closer in. So that's where a lot of the appetite is at the moment. It is predominantly Sydney and Melbourne. We're not seeing the same in some of the other areas so far. There is clearly a great appetite from banks to lend, right? I mean, banks need to lend to be able, because it's their it's their profit engine, right? So yeah, there is more availability than there was clearly for those particular types of deals, and the loan to value ratios are a bit more extended than they were, and some of the credit standards have been loosened. So yes, there is more credit availability, but it's not back to where it was 3 years ago, in my view.
Yeah, the way the banks are saying it now is it fell 30% and it's back 10 to 15 from those lows.
I'd agree with that from my data. The other point that's worth making, and you might have a view on this, there's a difference between the total loan exposure of a household in terms of the mortgage and the individual loans as reported to APRA from the banks. Because quite often that loan may be split between principal and interest, or interest only, or it might be structured into 2 or 3 loans. But each of the loans is reported separately because it's not reported at an aggregate customer level; it's reported at a loan level.
Yeah, I mean, if you look at the average sale, like kind of the sale of properties, to take the total value of sales from CoreLogic, the total number of sales divided, you end up with a figure that is about 2.5 times the average loan size, which is just not like, it's probably, the average loan is probably more like a maybe 50 or 60% LVR, but it's not going to be a 30% LVR.
So I think we're in for an interesting ride in the next couple of years, and I still think prices will be lower rather than higher in 2 years' time. All right? Okay. I hope that was some use. More on the website, more on the DFA blog, and on the YouTube channel. We do daily posts to YouTube and all this sort of stuff. So it's a part of the fun thing we do. Thanks for your time.
This train will stop at Hurstville. This station is Helensburgh. Next stop, Thirroul.
Well, here we are back on the south coast, having made my way back from Sydney. Quite an interesting discussion today, actually. And there were a few fund managers and some other people in the room. But I think there were 3 points that I took away. Firstly, the point about property prices not necessarily recovering on a broad basis in Sydney and Melbourne was validated from other intelligence shared by other parties. the interest from international fund managers in the Australian banks has pretty much gone through the floor. I think it's quite fascinating. And the third point that was validated again was that the government will do everything it can to try and talk house prices up. We'll try and get APRA and the RBA to continue to release the taps, as it were. And this is because the government wants to protect its surplus promise, and therefore will do anything it can to try and drive home prices higher to keep the economy afloat. Now, of course, we'll see down the track whether that works or whether it doesn't work. So, pretty interesting time. Worth the round trip to Sydney and back today. And I hope you found some of the points in the discussion interesting. Just to explain, I've edited out some of the other comments in the room because I didn't really have permission to recount those. And finally, just a quick reminder that tomorrow, Tuesday the 15th of October at 8 p.m. Sydney time, we're running our next live stream event. Hope to see you then. Here's the link if you want to bookmark it. And if you want to send a question in advance, you can still do so via the DFA blog. Links below. See you tomorrow.